See if I can get this thing going here. Another surprise live broadcast jumping on. We'll see if anybody joins us. Learning some of these different platforms and different ways we can get these live streams going, get this content out to you. But today I want to talk a little bit about hard assets, a little bit about what's going on in the markets, and just some of my opinions. So I'm not this is not financial advice. You do what you want. You're grown people. But this is just a little bit of information on what I believe is happening. And I've said it this way. You saw it in the caption. Like, I'm done playing at the Wall Street casino. I'm done spinning the wheel at Wall Street's roulette table. If I'm going to play at those stakes and those odds, then I would like to play blackjack instead. So when it comes to money, when it comes to building assets, I really want to focus in on really understanding, like, guys, the market has shifted, and the way that it's been done historically is not the same. And so it is time for us to stop moving into things that we don't understand and get our money into hard assets. We've got a lot of economic problems happening right now. A lot of people that are sitting on cash or even sitting in the markets, and inflation is eroding at the value of your retirement. It's eroding at the value of your wealth. And so I want to talk about getting us out of cash, out of these volatile areas, and into hard assets. And what do I mean when I say hard assets? Obviously, I'm a real estate guy. So real estate is where I'm going to talk the most about investing in hard assets. And real estate, though, is obviously not the only hard. I mean, there's precious metals, cryptocurrency. There's any number of businesses even would be considered hard assets. And so there's any number of places that you can put your capital that will be protected from inflation. Real estate just happens to be the one that I specialize in. And so that's the one that I talk about the most. And when we talk about hard assets, there's a lot of advantages. And that's kind of what I want to dive into is, what the advantages versus disadvantages are. But I'm trying to communicate this idea that people don't understand, which is this: when you are sitting on cash, you are losing money every minute of every day. Take it a step further, and we know that the markets right now are crazy volatile. And so we're trying to help people understand, like, let's get out of the Wall Street casino, let's get into hard assets, and let's start talking about ways that we can protect your money against inflation, grow it at a rate that is market leading, beats the market, and is secured by a physical asset. A couple of years ago, I cashed in all of my retirement, all my 401k, all my stock portfolio. I own a little bit of a couple of companies still, just that I like. I like Tesla, so I own a little bit. But overall, as a strategy, I am out of the markets. I am out of the Wall Street casino, and I'm in hard assets. And here's why. Because ultimately, at the end of the day, I realized I'm a finance guy. Those of you that know me, you know that I grew up in the bank. I spent the majority of my adult life in the banking finance industry. And I just had this revelation, like, I don't know what the heck is going on Wall Street. And like, that's my background. Like, this is where I come from, and I still don't understand. And I would get these analyst reports and these performance reports on a quarterly basis from mutual funds and from my 401k and from the different things that I was invested in. And they're packets this big with charts and graphs and analyst data, stuff that no average human, let alone somebody that grew up in the industry, if I can't understand it, how can the average person understand it? It just occurred to me, why am I investing in things that I don't understand? And so I started to do some soul searching and realized, like, most of the big wins that we've had has been in the real estate space. And we've learned, over the years, as we've purchased homes and purchased properties, it's been where a lot of our big financial wins have come from, is through the real estate game. And so, a lot of people are like, well, I can't get into real estate, right? Because they don't, I don't have a bunch of cash. I don't have these things. And, you can go back and watch our last live stream, or if you join in and get into our Dead Presidents Club group. We do weekly trainings on different ways you can get into the game. But here's the main point of why real estate is the solution that makes sense for me. First of all, over 90% of millionaires grow their wealth through real estate. That's just a statistical fact. So over 90% of people who become millionaires do it through real estate in some fashion. But the second piece of it is that in my opinion, it's the easiest asset to understand. So instead of getting, my stock portfolio or my mutual fund, analysis booklet that's this thick with charts and graphs that nobody understands, I look at an asset that has a door, that has a roof, that has a floor, that has HVAC and plumbing. And the most complicated things to analyze are the things that you can bring professionals in to help you analyze. But overall, as an asset class, it's kind of a dummy's investment asset class. Everybody understands what a property is. Everybody understands what a home is. Everybody understands at a high level how these things make money. Everybody, even if they don't understand the economic implications, everybody understands that, as time goes on, the values of these things rise. And as a simple metric of investment, I think real estate is the easiest asset class to understand and to underwrite. And so that's for those reasons, I'm a real estate guy. And so with that, what I want to talk about today is something that people do not often understand, which is that there's more ways to invest in real estate than just becoming a landlord. And a lot of people, I'm going to share my screen so I can draw some pictures for us. But what a lot of people think is that like the only way to get into real estate is that they got to store up a bunch of money, and then they got to go buy a rental property, and then they got to become a property manager or pay somebody else to manage the property. And although that is certainly one option, it's most definitely not the only option. And what a lot of people need to understand, and this is kind of the joke that we have in real estate world, which is the biggest problem with real estate. The biggest issue with real estate is that there are a million ways to make money in real estate. And I would argue that the number one reason why people are not invested in real estate is not because of money. It's not because of understanding. It's not because of knowledge. It's because they don't know which avenue to choose or how to even analyze the different avenues. And so I just want to talk about a couple of those avenues today, because you might be watching this and go like, I don't want to be a landlord. I don't want to be in real estate, because you think that like that's going to be, the only way would be for you to be a landlord. And that's absolutely not the case. The second thing that I want to talk about is the reality that most people do not understand that they have access to capital that can be deployed into hard assets out of the Wall Street casino and into real estate. And they don't even consider it their money because it's in their retirement accounts. And this is a big thing. People, because in a typical 401k, 401a, 401b, IRA, Roth IRA, and all of these accounts, in traditional formats, the only things you can invest in are stocks, bonds, and mutual funds. And so most people spend their lives believing that they're trapped by the Wall Street casino because those are the only options that have been made available to them. But what they don't know is that you can actually deploy those retirement funds into hard assets through a process called a self-directed IRA, which we're going to talk about here in a little bit. But most people, you'd be amazed at how many people, maybe you're watching and you're one that's included, how many people have $30, $50, $100,000 or more sitting in an IRA that they don't consider their money because it's retirement access. And it's at best getting, 4 to 6%, right, in the markets. If it's not losing money today. I was just talking to an investor the other day that pulled up their accounts. They're looking to invest, talking about real estate, and they pulled up their retirement accounts, and he texts me. He says, well, the good news is that I've only lost 15,000 since the last time I looked. That's terrifying, right? The fact that that's a possibility on just any given day is crazy. And you might say, well, real estate can crash too. Certainly, but there's a couple of fundamental differences. One of which is that there's some basic economics that drive real estate, and we understand what those basic economics are. The second piece is that the asset class of real estate is always spitting off cash flow if you're in these deals properly, and that's what we specialize in. And so, yeah, absolutely. Like if there's a market downturn, or if there's something that happens that brings the market down, well, guys, we just wait, right? But even while I'm waiting, it's spitting off cash flow that's adding to my retirement, adding to my monthly cash flow, adding to my income, whatever the structure is you've got set up. It's an asset class that continues to spit off positive cash flow, even if the market is in trouble. And so let's talk about a couple of ways that people traditionally invest in real estate. The one that everybody understands, right, is I go to Bank of America, and I apply for a loan, and I get a pre-approval, and then I go find a house on the MLS, and then I use the bank's money combined with a little bit of my money, and I go buy the house, right? That's the way that most people understand real estate. If they're, that's real estate 101. I get a loan from the bank, I put a little bit of money down, sometimes zero down, depending upon the product. And then I go on the MLS, which is the multiple listing service that is where, Zillow, Realtor, like all of these different platforms, they go on there, they find a home that fits their needs in their budget, and they make an offer and they buy that house. And that's real estate 101, real estate purchasing 101 for most people. If you're a little bit more advanced, then you understand that maybe I can get a second home, and then I go back to the bank and I ask for an investment or a vacation home loan, and maybe I only have to put 10 or 20% down on that property, but that's how I get a second property, right? And that's a little bit more complicated, but still very much in the realm of kind of like 102 real estate purchasing. But let me tell you, like that is the oversimplified way to buy and invest in real estate. And it will work over the long term. Like that's how we started in real estate. We bought properties over the course of our life because we knew it was a good idea to own real estate. So I'm not advocating that you don't do that, but I am advocating to say there are dozens of other ways that you can get into the game without having to go through the rigmarole of going to the bank, without paying top dollar on the MLS or on the market. And in many cases, completely passively, if you want to have double-digit returns, but not have to manage these properties. And so that's kind of what I want to talk about today, is some of those options. And so some of those options include a few things. One of which would be what we call note investing. And this is, whether you've got cash in your bank, or you have retirement funds that are in an old 401k or an IRA or 403b or whatever all of those things are. There are three primary ways that you can invest some of those resources secured by hard assets with double-digit returns, basically guaranteed, right? And so the first is what we call note investing. And, here's why we say that it's secured by hard assets, is because note investing is essentially the process of you becoming the bank. So let me share my screen, and I want to kind of walk us through like why this works and why it's such a secure alternative to, the typical investor paths. So I'm going to share my screen here. So when you buy an asset, right? When I buy an asset and this asset is worth 300K, right? When I go to Bank of America, right? And I'm going to go to the bank. They're going to give me, B of A, they're going to give me, generally on a typical purchase, 20% down. They've got products where you can do 3% down. They got products where you can do 0% down. Just depends upon the asset, the area, and whatever. But I'm gonna go to B of A, and in a normal scenario on a $300,000 purchase, I'm gonna have to put 20% down, which is $60,000, which means that Bank of America is going to fund this asset, $240,000 plus my $60,000 in cash. And this is the method that everybody understands. Well, that's true, and that's good, and that's fine, and that's how most of us buy the homes that we live in. But here's a few things that we don't understand. When Bank of America, when B of A, I don't know why this looks like a bank to me, but it does. When B of A lends me that $240,000, 240, what they're actually creating is a piece of paper called a deed of trust. And that piece of paper is what they use to secure their interest in my property. So they record against my property a deed of trust. And this is ultimately how banks protect their money. And we all know this. The number one, the most secure asset that, well, I shouldn't say we all know this, but many people understand that the most secure asset that a bank has on their balance sheet is mortgage-backed securities. Why is that? Why is it? Let me back it up a step. Why is it that when you put $1 into your bank account, they immediately digitize it and send it out 9 times? I don't know if people understand that, but your bank is not even holding on to the cash you put into your account. Your bank is, every time you put $1 into the bank, they are immediately converting it to a digital currency and lending it out up to 9 times. It's called fractional banking, and it's the way that banks make money. So if your financial institution, your bank, doesn't keep cash, then why are we? Like, why is that what we're taught to believe, that cash is king? Cash isn't king. Cash is trash. Cash flow is king. And that's what banks understand, that if I can convert every dollar into a cash flowing asset, not secured by the stock market, but secured by a hard asset, in this case, real estate, then of course I'm going to make my return because I've got cash flow coming in. And despite popular belief, it's the reason why it's hard to foreclose, because banks don't want homes. They want cash flow, but they like to have their interest through a deed of trust secured by a hard asset. And why is this? Because hard assets benefit from inflation. So if your banks understand that when inflation is happening, if banks understand that inflation is not going away, as long as the Fed's continuing to print money, inflation will exist. So what that means is that we need to get out of assets that are devalued during inflation and into assets that increase in value during inflation. And the only assets that increase in value are hard assets. And so real estate is the most obvious example of that. And it's the number one asset, most secure asset on any bank's balance sheet. And so with that being said, like, the point that I'm making here is, if that's the way the banks are making money, then why aren't we trying to model our investment strategy after that? Because if they're doing it so successfully, right, and in many cases, right, there's some exceptions to this where they get over levered and all those things we can talk about. But ultimately, we understand that they're no dummies. They get rid of cash immediately when it comes into their system. Immediately, they convert it to digital currency and lend it out, secured by hard assets. And so what they do is they issue that deed of trust to secured by a hard asset. And that deed of trust simply says this: when this asset gets sold, right, when there's a sale, the deed of trust, or in this case, Bank of America, is the first to get paid. And that's their security, right? When they issue a first deed of trust, when there's a sale of the property, this instrument tells the bank that I'm the first to get paid. So here's the good news: they're not the only ones that can do it. If you've got cash, if you've got retirement, IRAs, 401ks, 403bs, any of these Roth IRAs, any of these retirement products, what we've been taught to believe is that the only way you can invest them is in stocks, bonds, and mutual funds. But that's not true. One of the primary ways people invest in real estate is through their retirement funds. And here's how it works. I have, on one hand, we'll call it a 401k. Over here, I'll call it an IRA, right? And these are, buckets of money that I have sitting in an account. Maybe over here I got 30K, and over here I got, 70K for easy math, right? I am able to convert, in this case, both the IRA and 401k, if they're tax deferred accounts, I'm able to convert them into what's called a self-directed IRA. self-directed IRA. And if the 401k, it has to be an old 401k. It can't be an existing employer unless you're over 59 and a half. Then there's some different rules. It has to be an old 401k. You can't roll over an existing 401k plan until you're of age. But you can roll these into a self-directed IRA. So now, what's the difference? Still tax deferred money. So this 30,000 and the 70,000 is pre-tax money, and now it's in a new traditional self-directed IRA for $100,000. Here's where it gets interesting. I now have a litany of options available to me to deploy this type of capital. One of which is through a note investment. We'll just say note investment. Another one would be through an equity investment. Another one would be a solo project. So this is just talking about IRA funds or retirement funds, but there are more things you can do, obviously, with just straight cash. But let's talk about each of these. So let's start with what a note investment is. A note investment is exactly what it sounds like. Just like we talked about up here, where Johnny goes to Bank of America. Bank of America creates a deed of trust and gets a security in the property. You can do the exact same thing, except for now you are the investor, right? And Johnny, or in this case, Michael, like I do this with my investors all the time, instead of going to Bank of America, Johnny goes to the investor and says, hey, I need $100,000 to take down a property. Now that could be a portion of the property. That could be 100. It could be the total purchase price. It could be a portion of the purchase price. It could be just the renovations if it's a fix and flip. That money, and you talk about all that in every deal, but this money can be all of or a portion of the total asset. And then what we're looking at is we're saying, okay, so Johnny wants to take down this asset, right? And let's just say that it's, for easy math, obviously we're not buying $100,000 houses very often anymore, but you get the point. Johnny wants a $100,000 asset. Johnny goes to the investor, and the investor says, I've got the $100,000. And so the investor, instead of the bank, the investor creates, on Johnny, on the investor's behalf, creates a new deed of trust for $100,000 secured by the property. So now the investor becomes the bank as a private money lender. It's very simple. And so here's how this transaction works. If Johnny's buying an asset for $100K, that means that Johnny believes and has validation, right? Because when we buy our assets, we're buying them for 50 to 70% of market value. So when this thing is fully repaired and ready to go, it's going to be worth $200,000, right? So it's a $100,000 asset. That's at 50% of ARV, which is after repair value. So Johnny is saying, hey, I've got a $200,000 asset when I'm done that I'm purchasing for $100,000, and I need to fund that purchase. So the private money investor says, okay, I'll do that deal, but I want 10% interest only, and I want to be paid back in 12 months. These terms are listed in two documents. The first is a promissory note, which outlines these terms: 10% interest only, 12 months, and how it's paid. Is it paid monthly? Is it paid at the end of the time? Is it how is it paid? And then the second is deed of trust. This instrument is what protects the investor's $100,000 investment. What this means is that when the asset is liquidated, the first person to get paid is the person that has the first deed of trust. This is what it means to have. So let's just go through the sequence. Sally is the investor. Sally has $100,000 in an IRA. Johnny is the the buyer, right? He's the end investor, has an asset he's looking at that's a purchase price of $100K and an after repair value of $200K. Sally then takes her $100,000, converts it to a self-directed IRA, $100,000, which is super simple to do. She then creates a deed of trust document and a promissory note document, both of which get recorded by title against the asset. So now there are essentially 3 documents that exist on this asset: deed of trust, promissory note, and over here what's called a warranty deed. This is simply title of ownership. This is what says Johnny owns the property. But if this warranty deed is sold, if the property is liquidated for $200,000, when that property, we'll just walk it all the way out. So now the property gets sold, right, for $200K. That money goes into escrow first. Fees come out. First deed of trust. Johnny. This is the flow of money with a private money deal. Because Susie or Sally has a deed of trust for $100K, what that means is that when the property gets sold for $200K, that money goes into a third-party escrow. Johnny or the investor is not handling that. Escrow is managing that because it's a legal transaction. Then, the fees come out of that, right? So let's just say on a $200,000 transaction, there's $15K in fees, realtor fees, closing costs, all that different type of stuff. So then the first deed of trust, in this case, $100,000 to Sally has to be paid, which means that we now have $85,000 that comes back to Johnny at closing. That is one of the primary ways. Now, here's what happened. Here's the advantage, and here's why this works. Because Johnny took that $100K was 10% for 12 months, right? Which means that's $10K a year, or like $833 a month, roughly. This is Susie or I forget what we called her, Sally's return on investment, ROI. Sally gets 10% secured by the asset, completely passive for the duration of the project. So if this project takes 10 months, then she's going to get $833 a month for the duration of 10 months. And by the way, there's no rules on how this gets structured. This can be structured and negotiated any way you want. You can say, hey, it's going to be 10% flat fee for 12 months or less, which simply means that, hey, I'm going to get 10 grand when this property sells, you're going to pay me 10 grand, and you've got up to 12 months to take care of that. That's one way you can structure it. You could structure it simple interest, which is what most of my deals are, where it's like, hey, I'm going to pay you your interest, the $833 a month. I'm going to pay you that every single month, normally out of the cash flow of the property or whatever. And I'm going to just pay you your simple interest. And at the end of the 12 months, I have a balloon payment and I have to pay you that money back. The advantage of a note investment, like we're talking about here, is that as a private money lender, your investment, your initial capital is not contingent on the performance of the property or the performance of the project. In other words, if Johnny is unable to say, Johnny sells this thing for $120,000, and then escrow fees might come down to $10K, it doesn't change the deed of trust. That note is still in place. That money is still owed to Susie in this scenario. So Johnny, at the end of this deal, right, ends up coming out with $10K. That's not that exciting of a deal if it took him 6 months or 3 months or whatever it is to flip the property. Plus, he's had carrying costs, right? He's paid, if it took a year, Johnny's already paid $10,000 in interest to Susie as well. And so this might be a break-even deal for Johnny. But Susie doesn't care, or Sally doesn't care, because Sally's note was for a set amount of money, not based on the performance of the asset. This is the lowest risk way to passively invest in real estate, in my opinion, because you are putting money into a deal. You're getting a guaranteed rate of return set by the negotiation between you and the investor. And it's secured in a deed of trust position, just like a bank against the property. Now, the terms and the rates can be variable based upon the risk, because there are different risks involved, right? Sometimes if you're not bringing all of the cash to the deal, maybe you'll be in second position, not first position. So that means that when the property gets liquidated, you're the second to get paid. That's not necessarily a bad thing. But you just want to make sure that there's enough room in the deal that your interest is secured. And a good investor, a good real estate investor, will help explain to you, where your interest is, where your risk lies, all of these things. But ultimately, this is one of the best ways that investors I'm working with every day are getting out of the Wall Street casino. They're converting their retirement, their Roth, their IRA, their 401k, they're rolling them into self-directed IRAs, and they're helping fund deals for me between 8 and 12, sometimes even 14% interest, simple interest going straight back to their retirement, 3-4 times inflation, and obviously beating the market. In many cases, people are down 15% in their portfolios in the market. And so this is just a simple, straight way to go, I know where my money is. I understand the investment class because I understand the real estate, and I know how I'm getting my return. It's the simplest way to understand real estate investing, and it's completely passive. So let's go back up to the top here, because we talked about 3 different options. So I convert this 100,000, and here I'll go over here. So I converted. So again, right, this is my self-directed IRA. This is where I've rolled money from a 401k, an IRA, whatever, into this, and I put 100,000 into it. We talked about note investing, right? That's what we just covered. Now let's talk about, equity investing. Equity investing, super simple. It's the same terms, or it's the same process, right? I buy, I as a real estate investor, I don't buy very many properties, if any, on the market. I've got a whole process that we've developed where we go direct to seller, and we find these assets at a deep discount, and we provide, we provide the seller with terms that make sense to them, and we're buying properties that are worth 500,000 after they're repaired, or after we're done with them, we're buying those properties for 300,000, right? And we're doing that, and we can have a whole nother call for why, people always ask, well, why would people sell their properties for, 50 to 70% of market value. There are a lot of reasons that people will sell. There's, the simplest way I always say it is there's three components to any sale: speed, price, and convenience. And you'd be amazed at how many people will trade in a transaction. They get to choose two, never three, right? So you'd be amazed. They can choose speed, price, or convenience. And you'd be amazed at how many people will trade their price for speed and convenience, right? And that's one of the big value adds that we offer, is that we're able to, whereas if a retail buyer, if they're going to put it on the market, a retail buyer, they're going to wait 4 months plus 45 days for a conventional buyer to close their home loan. They're 5 to 6 months to get their capital out of this deal. We can close in 7 days, right? So that's one very simple reason why people might trade their price for speed and convenience. There's a lot of other reasons, but that's what we do, right? So we find in an equity deal, I, as a real estate investor, am finding a property that's worth, let's say, the ARV, right, which is the after repair value, is $500,000, right? And from the after repair value, right, my purchase price is $300,000, but my renovation estimate is $50,000. Okay, so I'm into this deal $350,000, and let me just double check my math, make sure I don't misspeak. Perfect. So we are into this deal $350,000, which is 70% LTV. So as a private money or a real estate investor in an equity deal, I could bring in, so for this 300, if the purchase price is 300, I could get an investor loan for, let's say, 300,000. I can get an investor loan for about 250, right, of this 350, which means that I'd be 100,000 short for my total amount that I need, which is where an equity investor comes in, right? And so an equity investor would come in and say, hey, I'll bring the 100,000 into the deal because I like the loan to value position, and I understand that, the property is going to be worth, we're going to have 150,000 in equity. And so 6 months goes by and we're renovating the property. And then what ends up happening is we sell the property, and with an equity investment, we'll go sale. With an equity investment, you're not getting like over here, you're not getting a promissory note with 10% interest only for 12 months. What you're getting is a percentage of profit. That's what an equity deal looks like. So in a deal like this, it wouldn't be outrageous if somebody was bringing 100,000 on the $350,000 funding for that to be a 50-50 split. That would not be uncommon, but it's all, again, it's negotiable, right? And it depends, like, what's the risk profile, who's doing the work, and so I'm doing a deal right now on a fourplex, right, where an investor's coming in and they're going to be they're bringing capital to the deal to pay for renovations, and we're going to own this property 50-50 as a joint venture, right? And so when this property sells, if it sells for $500K, right, the same process happens. First, the money goes to escrow, right? Then fees, then deeds of trust, which we'll come back to in a minute, then profit. Well, actually, initial capital, profit. So, and in this case, it's 50-50. So 500,000 comes into escrow on a $500,000 deal. Let's call it 40K in fees. Now, deeds of trust, right? First gets paid first. First deed of trust in this case was my $250,000 investor loan, right? So that's $250K that's going to come out of that. Now, there's a couple of ways you can structure this, right? Like if you're the private money investor on that 100,000, you can also record a deed of trust for that money on top of that. It's not necessary, but it's generally a good idea, because also if one of the exits is a refinance, it makes the refinance a little bit easier. But not all of that to be said. First, the 250, then the $100,000 initial investment gets paid back. And in this case, what's left is 350, 390, 110,000 in profit, split two ways. So 55,000 to the investor and 55,000 to the private money lender. Now, this obviously is a far more exciting return on investment than a private money loan. The disadvantage, though, is that you are not, unlike the performance of a deed of trust and a promissory note, where your capital is not contingent on the performance of the asset. With an equity deal, that's the risk. You're sharing in the risk and the reward. So if this property, the market tanks, something happens, we get in way over budget, and this property ends up being only $400,000, right? And then we go through, the same sequence happens. So we got 400, we got 390, we got 290. Your initial capital in this scenario would come back to you, but now 390, our profit is 10K, and you took a lot of risk to make and this would be considered a good scenario on a project that went bad, right? And so the advantage is it's a risk reward equation, right? And we like to believe that, like, we're in these deals in such a way that we're mitigating our risk, but there is risk in any type of investment. And so the risk reward ratio is just really dependent upon what's interesting to you and what your risk tolerance is. So a lot of people decide, so coming back to the self-directed IRA options, right? We've got the note investment, set rate of return for a set period of time, for guaranteed, secured by a deed of trust on the property. It's a pretty straightforward deal. You're going to know what you're going to get paid. You're going to get paid. You're going to know when you're going to get paid and how you're going to get paid, and all of those things. With an equity investment, you still understand these things, but you're playing the game with the investor. You're playing the game to say, hey, if this thing's going to make $100,000, then I'm going to get $50,000 or $40,000 after fees, and that's a risk worth taking. And that's what a lot of people have to just balance between. I would say most of my investors are note investors, because it's a lower risk option with set returns that are often double digits, way beating the market, and they're happy because they don't have to have any of the headache or the stress of wondering how the asset's performing. They're just happy to take their cash flow off of the deal. But equity investments have the potential to be a more lucrative outcome. The third and the last one, which I don't need to spend a ton of time on, is performed deals. So you actually have the opportunity on a self-performed deal to buy your own fix and flip, still using retirement money. Now, here's a really important thing that I forgot to outline in any one of these scenarios. So let me find some space here. So if I've got 100,000 in self-directed IRA, no matter what place I go, if I go note, if I go equity, or I go self, in any one of these scenarios, the profit. So in this case, the profit is the interest. In this case, the profit's the equity. In this case, it would be equity. The profit goes back to the self-directed IRA. That is the important thing to understand, is that in a self-directed IRA, all profit funnels back to the self-directed IRA because it's tax deferred, right? And so you can make distributions, you can take withdrawals, just like a normal IRA, but all of the profits from funds that come through the self-directed IRA has to go back to the self-directed IRA. So I know I haven't had people been jumping in and out, and I'm on like 4 different platforms here. So I'll try to see if I can look at all of them. But let me stop here and just see what questions there are specifically around these different types. And you can just drop them in the comments if you're curious or have any questions, anything you want me to specifically to cover. And I'm going to look on a couple of these other platforms here. One of the questions is there a minimum account size? There's not technically a minimum account size, although it's probably not worth the work or the energy, unless you've got, maybe 20 or 30,000, I would say is probably where you want to start thinking about the opportunities. That's not always true. Like if you're a wholesaler, people can wholesale in their self-directed IRAs, and you can use, $5,000 or $6,000 to be earnest money deposits for wholesale deals, and then ultimately convert those deals to back to your IRA. So no real minimum account size, but I would say 20 or 30,000 is where most people start. One thing that I'll add as well that I probably should have started with, but I'm not good at marketing, is that we have developed a relationship and we're actually able to facilitate self-directed IRA conversions and allocation of assets into real estate on your behalf. And so that's big news for us, is that we've struck a partnership with Horizon Trust, and we're now able to allocate through our capital company we've started, which is it's called Capital by Dead Presidents, and we're able to help people convert their retirement assets into real estate and hard asset investments backed by real estate to get, in many cases, double-digit returns. They are protecting their assets against inflation and ultimately, beating the market. Here's one other thing I'll add, and if they're, I'm just looking at some other questions. Yes, you can pull. I'll put the link up. I'll figure out how to put the link where you can go to the website and see how to do that, or you can send me a DM and I can help you with that as well. But let me show you one other reason why hard assets, particularly real estate, to me, is leaps and bounds better than a typical stock market investment. And here it's simply this. It's simply through leverage. If I put $100,000 into the stock market at, say, 6%, or let's be generous. Let's call it 8%. My ROI annually is on that $100,000 is going to be $8,000. Very simple. If I put $100,000 into real estate deals, that gives me $500,000 at minimum of asset value. Why? Because $100,000 in the stock market is $100,000 in the stock market is $100,000 in the stock market. But $100,000 in real estate through leverage allows me to buy $500,000 worth of assets at minimum. And if my ROI is even the same, which, by the way, my average cash on cash return on my real estate deals is between 20 and 30%. So I'm crushing the market in my deals. But let's just say that in the same scenario, if I got apples to apples returns on that same amount of money, 8%, that would provide me $40,000 ROI. So $100,000 in capital deployed in Wall Street gives me $8,000. $100,000 in capital deployed in real estate gives me $40,000. It's very simple math to me. And so, and again, we're not even talking about the pieces of just understanding what these deals are and how easy it is to analyze a real estate deal. And you just learn a couple of things, you learn a few things, or you don't want to learn anything at all, and you partner with somebody who does these things. And you get, I just showed you a scenario. I could flip my camera around and show you my wall of active deals right now where people are getting paid thousands of dollars a month to passively be invested in our projects. And so I wanted to get on and go and just say a couple of things. One, if you're sitting on cash, you need to get your cash into assets. I don't care go buy gold for all I care, but get out of cash and into a hard asset that provides you an inflation protection asset that benefits from inflation. Because what I love about what we're doing is I'm like, bring on inflation. I actually want it. Hyperinflation, even better. Why? Because 100% of my net worth is tied up in hard assets, and hard assets benefit from inflation. And so until something changes and they decide they're going to stop printing money, everything I own is going to be in really good shape. I love inflation. And if you don't love inflation, it's because you're not in hard assets and you haven't seen the value and the power of getting out of the Wall Street roulette table and into a hard asset class. So if you're in just straight cash, you please, whether it's our deals, whether it's syndicates, whether it's like, if you want advice, not even to invest in our deals, but if you just want a couple of like places directions I could point you for different places that you can get into the real estate game, or other hard assets, just DM me and I'll help you. I'd be happy to help you. But please get out of cash. And if you're sitting on an old 401k, an IRA, or even an active 401k and you're over 59 and a half, please let me know and I can help you convert that capital into self-directed, and you can move it out of the stock market and into hard assets with double-digit returns, fixed by real estate. And it really sounds too good to be true, but we're doing it every single day. We've deployed almost $1 million in capital in the last month for people. And I think we're up to like 7 or 8 million in total acquisitions in the last 12 months. And so we've got, we're doing this at such a large clip. We've got access to these deals that really help secure your investment and ultimately help provide you with the growth you need to really beat the retirement odds. So those are my kind of points for today. If you got any other questions, I'll hold on for just one more minute. I'll check these different platforms out. You can drop it in the chat. If not, let me pull this one up. All right. No questions here. Okay. All right. I will end our time together here. Have a great weekend, everybody. Go get into those assets.